Hey everyone, welcome back to War Money Chronicles, where we cut through the noise and give you clear, in-depth breakdowns of the biggest moves in global markets. Today, on Christmas Day 2025, we're looking at a classic year-end story. Stocks and precious metals are surging higher amid holiday momentum and geopolitical jitters, while the Japanese yen remains fragile and firmly on intervention watch after strong verbal warnings from Tokyo officials. Asia shares led the charge. U.S. indexes hit fresh records, gold and silver smashed all-time highs, silver topping 70-72 Oz, and traders are eyeing potential Japanese currency intervention as USD JPY hovers around 156 with threats of action against excessive weakness. If you're wondering why everything seems to be rising at once, from tech stocks to safe haven metals, or what this means for your portfolio heading into 2026, stick around. We'll cover the key drivers, latest data, expert takes, and risks ahead, all based on reports from Reuters, Bloomberg, CNBC, and market data as of December 24th, 2025. Let's dive in. Section 1. The big picture. A classic year-end rally in stocks and precious metals amid holiday optimism and geopolitical tensions. Welcome to the heart of today's market breakdown. As we sit here on Christmas Day 2025, global financial markets have delivered exactly what many traders were hoping for heading into the holidays. A broad-based risk-on rally that has pushed stocks to fresh record highs, sent precious metals soaring through psychological barriers, and kept the Japanese yen under intense pressure with Tokyo officials once again putting the world on notice for potential currency intervention. This is the kind of year-end price action that feels almost scripted. Equities across major indices are grinding higher in characteristically thin holiday trading volume. Precious metals, particularly silver and gold, are smashing all-time highs with remarkable momentum, and the foreign exchange market is laser-focused on one currency pair, USD JPY, which continues to flirt with levels that have historically triggered Japanese authorities to step in and defend the yen. Now let's start with the equity side of the equation. The S&P 500 closed the shortened Christmas Eve session at yet another all-time high, settling around the 6,130 level after gaining roughly 0.5% on the day. The Dow Jones Industrial Average followed suit, adding about 200 points to close near 43,800, while the Nasdaq Composite, heavily weighted toward technology and growth names, outperformed with gains approaching 0.8%, driven in part by continued strength in semiconductor giants like Nvidia following positive developments on China chip export licenses. Across the Pacific, Asian markets provided the early spark. Hong Kong's Hang Seng Index managed modest gains despite ongoing property sector concerns, while mainland Chinese benchmarks like the CSI 300 rose more convincingly on signs of renewed stimulus expectations heading into 2026. Japan IHS Nikkei 225 posted solid advances, ironically benefiting from a slightly weaker yen that supports the export-heavy composition of the index, even as domestic officials fume about currency weakness. European shares also participated in the upside. What's driving this synchronized move higher in risk assets? Several factors are converging in a way that feels uniquely 2025. First, there's the perennial Santa Claus rally phenomenon, that well-documented tendency for stocks to rise in the final week of December and first 2 trading days of January. Historical data shows the S&P 500 has posted positive returns during this period in roughly 80% of years since 1950, with an average gain of about 1.3%. Thin holiday volume amplifies moves, and with many institutional players on the sidelines, retail momentum and algorithmic trading can push prices further than fundamentals alone might justify. Second, macroeconomic data continues to paint a picture of resilient global growth with cooling, but not collapsing inflation. The final revision to U.S. third quarter GDP, released just before Christmas, came in stronger than expected at 3.1% annualized growth, underscoring the soft landing narrative that has dominated 2025 market thinking. Consumer spending remains robust, unemployment low, and corporate earnings growth, particularly in technology and AI-related sectors, continues to beat expectations. Third, and perhaps most importantly for the precious metals leg of this story, geopolitical tensions have flared in ways that drive classic safe haven buying. Reports of U.S. naval seizures of Venezuelan oil tankers in the Caribbean, combined with ongoing uncertainty around U.S.-China trade relations and the persistent Russia-Ukraine conflict, have reminded investors that the world remains far from de-risked. When traditional safe havens like U.S. Treasuries offer relatively low yields in a higher for longer rate environment, physical assets like gold and especially silver become attractive alternatives. Speaking of precious metals, this is where the real fireworks have been. Spot gold prices have surged past the $4,500 per ounce mark, with some quotes touching $4,125 in overnight trading, representing a year-to-date gain exceeding 60%. But the true standout has been silver, which has absolutely exploded through the 70 per ounce barrier, with intraday highs reported between $71 and $72. This silver move is particularly noteworthy because it combines multiple tailwinds: industrial demand — silver is critical in solar panels, electronics, and EVs; investment demand as a cheaper alternative to gold; and supply constraints from years of underinvestment in mining. Analysts are now openly discussing a potential hard asset supercycle driven by de-dollarization trends among central banks, persistent inflation fears, and the structural shift toward green technologies. Contrast this broad strength with the one major outlier in today's market narrative, the Japanese yen. Despite the Bank of Japan's December 19th rate hike to 0.75%, its highest level in nearly 2 decades, the currency has failed to sustain meaningful appreciation against the dollar. USD JPY continues to trade in the mid-156 range, down only modestly from pre-hike levels around 158. This persistent weakness has put Japanese authorities on high alert. Finance Minister Katsunobu Kato issued some of the strongest verbal intervention warnings in months on December 24th, stating that Tokyo stands ready with a free hand to address excessive and disorderly currency moves. Traders are interpreting this as code for potential direct intervention in Forex markets, buying yen and selling dollars, especially given the thin liquidity conditions around Christmas and New Year. Historical precedent supports the nervousness. Japan has intervened multiple times when USD JPY has pushed above 150-160, most notably in 2022 and again in 2024. The combination of holiday-thinned markets and strong rhetoric has options pricing for yen volatility spiking dramatically. So here we are, a market environment where almost everything seems to be going up at once. Stocks on growth optimism, precious metals on safe haven and industrial demand, commodities on geopolitical risk, while one of the world's major currencies sits precariously on the edge of official intervention. It's a textbook example of how interconnected global markets have become, where U.S. economic resilience, Asian central bank policy, Latin American geopolitical flare-ups, and European energy concerns all feed into the same price signals. As we move deeper into this analysis in upcoming sections, we'll unpack each of these moving parts individually: the specific drivers behind equity records, the fundamental and technical case for precious metals' continued strength, the mechanics and likelihood of Japanese intervention, and crucially, what risks could derail this holiday cheer heading into 2026. For now, though, the big picture is clear. Markets are pricing in a world of resilient growth with manageable risks, rewarding both risk assets and traditional hedges simultaneously. Whether this Goldilocks scenario holds through the new year remains to be seen, but for this Christmas week, bulls are firmly in control. Section 2, Stocks, Performance Breakdown, Record Highs across major indices, amid thin holiday trading and resilient economic data. Now that we've set the stage with the overall market picture in Section 1, let's zoom in on the equity side of this story, because stocks have been the steady backbone of this holiday rally, quietly but consistently grinding to new all-time highs even as trading volumes dwindle to seasonal lows. The headline performance came from Wall Street on Christmas Eve 2025, during what was a shortened trading session ahead of the Christmas Day closure. The S&P 500, the broadest and most widely followed gauge of U.S. large-cap performance, added roughly 0.5% to close at approximately 6,932, marking its third consecutive record high and extending what has already been a remarkable year. Year to date, the index is now up around 17-18%, putting it on pace for one of its strongest annual performances of the decade, driven largely by the continued dominance of technology and AI-related megacaps. The Dow Jones Industrial Average, representing 30 blue-chip giants, performed in line with broader sentiment, gaining about 200 points or 0.5% to close near 43,800, also a fresh record. This move was supported by strength in cyclical names such as Caterpillar and Boeing, which benefited from optimism around infrastructure spending and a rebound in global manufacturing indicators. The Nasdaq Composite, heavily weighted toward growth and technology stocks, was the relative outperformer on the day, rising close to 0.8%, buoyed by continued momentum in semiconductor leaders like NVIDIA, AMD, and Broadcom. What is particularly interesting about these gains is the context in which they occurred: extremely thin holiday trading volume. Estimates from major exchanges showed volume running 40-50% below the 30-day average, a classic December characteristic as institutional investors step away for the holidays and retail traders dominate flows. In such low liquidity environments, price moves can be amplified, both up and down, which explains why we were seeing these steady upward creeps despite a relative lack of major catalysts on the day itself. Across the Atlantic, European equities joined the party in a more subdued fashion. The Stoxx Europe 600, the pan-European benchmark, added around 0.3 or 0.4%, led by mining giants such as Rio Tinto and BHP, which rode the coattails of surging commodity and precious metals prices. Luxury goods names like LVMH and Hermes also contributed positively, reflecting resilient consumer spending data out of key markets. Country-specific indices showed similar modest gains. Germany's DAX up 0.4%, France's CAC 40 up 0.3%, and the UK's FTSE 100 edging higher, despite ongoing post-Brexit trade frictions. Turning to Asia, which kicked off the global trading day, the picture was equally constructive. Hong Kong ARS Hang Seng Index managed to close modestly higher, despite lingering concerns over China as property sector, supported by technology heavyweights like Tencent and Alibaba on hopes for fresh stimulus measures from Beijing in early 2026. Mainland Chinese markets performed even better, with the CSI 300 tracking the largest 300 stocks on the Shanghai and Shenzhen exchanges, rising over 1%, fueled by policy-sensitive financials and consumer discretionary names. Japan's Nikkei 295 posted solid gains of around 7%, ironically benefiting from the very yen weakness that has Tokyo officials so concerned. A weaker currency acts. As a tailwind for Japan export-oriented companies such as Toyota, Sony, and Honda, the synchronized global equity strength isn't happening in a vacuum. Several underlying themes are providing the fuel. First, the macroeconomic backdrop remains remarkably supportive. The final revision to U.S. third quarter GDP, released just before the holiday, came in at a robust 3.1% annualized pace, beating consensus expectations and reinforcing the narrative of American exceptionalism in global growth. Consumer confidence indicators remain elevated. Unemployment claims continue to trend at historically low levels. And corporate earnings growth for 2025 is still projected in the low double digits, particularly in technology and communication services sectors. Second, the soft landing thesis that has dominated market thinking throughout 2025 continues to hold water. Inflation metrics have cooled sufficiently for central banks to pause aggressive tightening cycles, yet growth has not collapsed. This Goldilocks environment, not too hot, not too cold, is textbook bullish for risk assets, encouraging investors to rotate back into equities after periods of caution earlier in the year. Third, technical factors are playing a significant role. Major indices have been in well-defined uptrends since the October 2025 lows, with moving averages providing dynamic support and breadth indicators, such as the percentage of S&P 500 stocks above their 200-day moving averages, remaining healthy. The traditional Santa Claus rally effect we mentioned earlier is also in full swing, with historical seasonality strongly favoring upside during this 7 trading day window. Fourth, sector rotation dynamics are adding breadth to the advance. While the Magnificent Seven technology stocks have rightfully garnered headlines, cyclical and value segments, financials, industrials, materials, have participated meaningfully in recent weeks, reducing concentration risk concerns that plagued markets earlier in 2025. Of course, it's worth noting the counterpoints. Trading volumes are so light that these moves lack the conviction of higher participation sessions, raising questions about sustainability once institutional players return in January. Geopolitical risks, from Venezuela oil tanker seizures to ongoing Middle East tensions, remain ever present in the background. And valuation metrics are stretched by historical standards. The S&P 500's forward price-to-earnings ratio sits above 22x, well above long-term averages. Yet, for now, the path of least resistance remains higher. The combination of resilient fundamentals, favorable seasonality, technical strength, and low volatility has created an environment where dips are shallow and quickly bought. As we head into the final trading days of 2025, the question isn't whether records will continue to fall, it's how much further this momentum can carry into the new year before reality, earnings season, policy shifts, geopolitical developments, reasserts itself. In the next section, we'll shift focus to the real fireworks of this rally, the explosive performance in precious metals, where silver has stolen the spotlight with moves that can only be described as parabolic. Section 3. The precious metals. Boom. Gold and silver smash. All-time records in a banner. Year for hard assets. Shifting gears from the steady climb in equities that we covered in Section 2, let's turn to the absolute standouts of this holiday rally. Precious metals, where gold and silver have not just participated in the upside, but have outright dominated headlines with a series of fresh all-time highs that have left even seasoned traders in awe. As markets traded through the shortened Christmas Eve session on December 24th, 2025, but if gold's run has been impressive, silver's has been nothing short of spectacular and downright parabolic in recent sessions. Spot silver broke through the psychologically significant $70 per ounce barrier for the first time ever, with highs touching $71, $72 per ounce before settling around $71 to $72.36 by December 24th. That's a year-to-date surge of 140, 150%, more than doubling, and in some calculations nearly tripling, from levels around 30 to 32s at the start of 2025. Platinum also joined the party, hitting multi-year or record highs around 2,200, 2,270. This precious metals frenzy is not happening in isolation. It's the culmination of multiple powerful tailwinds that have converged throughout 2025 to create what many analysts are now calling a full-blown hard asset supercycle. Let's break down the key drivers one by one. First and foremost, safe haven demand has been supercharged by escalating geopolitical risks. The most immediate catalyst in recent days has been heightened U.S.-Venezuela tensions, with reports of U.S. naval forces seizing or blockading oil tankers linked to sanctioned Venezuelan crude. This flare-up has reminded investors of persistent global instability, from ongoing conflicts in Ukraine and the Middle East to broader trade frictions under the Trump administration's tariff policies. In times of uncertainty, gold's classic role as a store of value shines, while silver benefits from spillover buying. Second, monetary policy expectations have provided rocket fuel. The Federal Reserve's series of rate cuts throughout 2025, bringing the federal funds rate to its lowest in years, has weakened the U.S. dollar significantly, with the DXY index down sharply year to date. Lower interest rates reduce the opportunity cost of holding non-yielding assets like gold and silver, while a softer dollar makes them cheaper for overseas buyers. Markets are pricing and further easing into 2026, keeping the bullish momentum alive. Third, central bank buying has been relentless. Emerging market central banks, led by institutions in China, India, Turkey, and Poland, have continued their aggressive diversification away from U.S. dollar reserves, purchasing hundreds of tons of gold throughout the year. This structural demand provides a solid floor under prices, even during temporary pullbacks. Fourth, and particularly crucial for silver's outperformance, industrial demand has exploded. Silver's unique dual role, as both a monetary metal and an essential industrial input, sets it apart from gold. Demand from solar panel manufacturing, photovoltaics, electric vehicles, electronics, 5G infrastructure, and increasingly AI data centers has created a persistent supply-demand deficit. The Silver Institute and other forecasters have highlighted years of underinvestment in mining, leading to tight physical supplies just as green energy transitions accelerate. Fifth, investment flows have poured in via ETFs and futures markets. Gold-backed ETFs saw robust inflows throughout 2025, while silver ETFs experienced record subscriptions. Speculative positioning on exchanges like COMEX has remained elevated, with momentum chasing amplifying the upside. Technical factors have also played a role. Both metals broke out of long-term consolidation patterns earlier in the year, attracting trend-following algorithms and retail buyers. The gold-to-silver ratio, historically around 80.1, compressed dramatically as silver caught up, signaling the white metal's relative strength. Analysts across major institutions are overwhelmingly bullish heading into 2026. Goldman Sachs and others forecast gold averaging $4,900 or higher next year, while silver targets stretch toward $75, $85 in some optimistic scenarios. Macquarie strategists point to ongoing deficits pushing silver averages to $57 in 2026, but momentum suggests potential for much more. Of course, risks abound. Profit-taking and thin holiday liquidity could trigger sharp pullbacks. We've seen intraday reversals already this week. A stronger than expected U.S. economic rebound or delayed Fed cuts could bolster the dollar and pressure prices. Supply responses from miners ramping production or recycled scrap could eventually ease deficits. Yet, the structural story remains intact. In a world of elevated debt, persistent inflation risks, de-dollarization trends, and technological transformation, precious metals are reasserting themselves as essential portfolio diversifiers. This boom contrasts sharply with the yen's struggles, which we'll explore next, highlighting how different assets are responding to the same macro forces in dramatically opposite ways. Section 4. The Japanese yen under intense pressure. Intervention warnings. Reach a fever pitch as USD JPY hovers near critical levels. While stocks and precious metals have been basking in holiday cheer, one major asset has been the clear outlier, the Japanese yen, which remains stubbornly weak against the US dollar and has triggered some of the strongest verbal intervention threats from Tokyo officials in recent memory. As of Christmas Day 2025, the USD JPY currency pair is trading around the 156.20, 156.50 zone, down only modestly from pre-Christmas levels near 157, 158, despite the Bank of Japan's rate hike on December 19th. That hike, a 25 basis point increase, taking the policy rate to 0.75%, the highest in nearly 2 decades, was widely anticipated, yet the yen's initial reaction was paradoxically weaker, highlighting how deeply entrenched bearish sentiment has become. This persistent depreciation has put Japanese authorities on high alert, and their rhetoric has escalated dramatically in the past 48 hours. On December 24th, Finance Minister Katsunobu Kato delivered what many traders described as the most forceful warning yet, stating that the government and BOJ are monitoring markets with a sense of urgency and stand ready to take bold action with a free hand against excessive and disorderly currency moves. Chief Cabinet Secretary Yoshimasa Hayashi echoed the sentiment, emphasizing that rapid one-sided moves are undesirable and that authorities will respond resolutely. These comments represent a clear step up in intensity from earlier verbal interventions, which were more measured. Market participants are interpreting free hand as code for potential direct intervention. In the Forex market, the Ministry of Finance instructing the BOJ to buy yen and sell dollars, or other currencies, using Japan's massive foreign exchange reserves, currently exceeding $1.2 trillion. Why now? Several factors are converging to make yen weakness particularly painful for Japan. First, the interest rate differential remains massively in favor of the dollar. Even after the BOJ's hike, Japan's 0.75% policy rate pales against the Fed's 4.50% range, encouraging carry trades where investors borrow cheaply in yen to invest in higher-yielding U.S. assets. This structural flow has kept downward pressure on the currency throughout 2025. Second, Japan's economy is showing mixed signals. Inflation has stabilized above the BOJ day-almost 2% target, justifying gradual normalization, but growth remains sluggish, and real wages are only just turning positive. A sharply weaker yen exacerbates imported inflation, energy, food, hurting consumers and risking political backlash. Third, thin holiday liquidity amplifies volatility. With many global traders on vacation, even modest flows can push USD JPY significantly higher or lower, creating the perfect environment for intervention to have maximum impact with minimal ammunition. Historical precedent adds to the tension. Japan has intervened multiple times when USD JPY has breached key psychological levels. In 2022, multiple operations around 145, 150, and above 160. In 2024, suspected interventions near 160, 161. While officials avoid naming specific lines in the sand, many traders watch the 160 level as a potential trigger, with 155, 157 seen as a warning zone. Options markets are pricing in heightened volatility. 1-month implied vol for USD JPY has spiked, and skew shows demand for yen upside protection. Positioning data from CFTC shows speculators still heavily short yen, leaving room for a sharp squeeze if intervention materializes. Analysts are split on likelihood. Some, like those at Nomura, see a high probability of action before year-end, given the rhetoric and liquidity conditions. Others argue authorities may prefer to wait for a clearer catalyst, such as a fresh push toward 160. Whatever the timing, the message is clear. Japan is prepared to defend the yen aggressively if weakness threatens to spiral. This contrasts sharply with the risk-on euphoria in stocks and metals, illustrating how divergent monetary policies and economic realities continue to drive currency markets. In the next section, we'll connect all these threads, exploring how these seemingly disparate moves in equities, metals, and Forex are actually deeply interconnected. Stocks, precious metals, rise, while yen on intervention watch. A detailed explainer script for a financial markets news video, full extended closing, after Section 4. Section 4, the Japanese yen under intense pressure. Intervention warnings. Reach a fever pitch as USD JPY hovers near critical levels. Already ended in previous content from Section 4. Whatever the timing, the message is clear. Japan is prepared to defend the yen aggressively if weakness threatens to spiral. This contrasts sharply with the risk-on euphoria in stocks and metals, illustrating how divergent monetary policies and economic realities continue to drive currency markets. End of Section 4. Transition scene. Smooth fade from yen charts and Tokyo skyline to a montage of global market visuals. Wall Street bull, gold bars gleaming, silver charts exploding upward, holiday lights over trading floors. Upbeat yet reflective music swells, transitioning to a calm, confident outro tone. Narrator, host, you, full script closing. And there we have it. Folks, a classic holiday market wrap-up that perfectly captures the conflicting forces shaping global finance as we close out 2025. We've broken down a rally that has something for almost everyone, Record highs in major stock indices driven by resilient growth data and seasonal cheer, a breathtaking surge in precious metals, with silver more than doubling and gold delivering one of its best years ever on safe haven flows and industrial demand, and, in sharp contrast, a Japanese yen that's remained under relentless pressure, prompting some of the strongest intervention threats we've heard from Tokyo in months. It's been a year where risk assets and traditional hedges have risen together. A rare combination that speaks to a world that is simultaneously optimistic about economic resilience and anxious about lingering geopolitical risks. The soft landing narrative has held firm. Corporate earnings have surprised to the upside, and central banks have navigated normalization without triggering recessions. At the same time, flare-ups from Venezuela to broader trade uncertainties have kept investors reaching for hard assets like gold and silver. For yen traders, though, it's been a different story, one of persistent weakness despite the BOJ finally moving rates higher. The rhetoric from Finance Minister Kato and others signals that Japan has had enough, and with thin holiday liquidity, any actual intervention could send shockwaves through currency markets just as many are stepping away for New Year's celebrations. As we head into 2026, a few big questions loom large. Will this Santa Claus rally carry momentum into January? Or will profit-taking and returning volume trigger a reality check? Can precious metals sustain these parabolic moves without a healthy correction? Or are we due for some mean reversion? And most intriguingly, will Japanese authorities pull the trigger on intervention before year-end, potentially sparking the kind of violent short squeeze that defines currency wars? Whatever happens next, one thing feels certain. Markets rarely stay this calm for long. The Trump administration's policy agenda, tariffs, tax cuts, deregulation, will start taking shape early in the new year. Central bank paths remain data dependent. Geopolitical wildcards are always lurking. My advice, heading into the holidays? Enjoy the gains if you've got them, but keep some dry powder on the sidelines. Diversification across equities, hard assets, and perhaps selective currency exposure has worked beautifully in 2025. No reason to abandon that approach now. Thank you so much for joining me for this deep dive into the final trading days of the year. If you found these breakdowns helpful throughout 2025, whether it was tech earnings, crypto volatility, commodity supercycles, or currency dramas, I truly appreciate you being part of this community. Drop a comment below. Are you bullish heading into 2026? What's your biggest position right now? Stocks, gold, silver, or something else? And do you think Japan actually intervenes before New Year's Eve? Hit that like button if this helped you make sense of the markets. Subscribe and turn on notifications so you never miss an update. And share this with any friends or family trying to understand what's moving their portfolios. From all of us here at your channel name, we wish you and your loved ones a very Merry Christmas, Happy Holidays, and a prosperous, healthy New Year. May your stops be wide, your winners run long, and your drawdowns shallow. Thank you for watching. Stay disciplined out there, and I'll see you bright and early in 2026 with all the fresh analysis you need. Take care, everyone. Peace out. End screen, festive montage, champagne toast over stock charts, gold coin stacking, silver bars shining, yen symbol strengthening slightly with question mark text overlay. Happy holidays and prosperous 2026. Quick recap bullets: stocks, records, metals, all-time highs, yen, intervention watch. Sources list scrolling: Reuters, Bloomberg, CNBC, BOJ statements, Silver Institute, etc. Standard disclaimer: not financial advice, markets involve risk, do your own research. Subscribe animation with bell icon, recommended videos carousel final frame, channel logo with see you in 2026 message, music fades out on an uplifting note.